When thinking about retirement, a lot of the focus goes on managing taxes and investments in your retirement accounts. But there are other types of accounts that deserve your attention. These non-retirement accounts, also known as taxable brokerage accounts, can also be quite tax friendly, even though the name includes the word taxable. And I've found that a lot of clients don't really know that these accounts exist. And if they do know about them, they don't have a clear understanding of how exactly they work. So that's what we'll talk about. We're covering these taxable non-retirement accounts, and we're going to go over the basics of how they work. And then we'll get into some strategies or how you can use them in a tax-friendly way as you do your long-term planning. Starting out with some highlights, I just want you to know that it is possible to invest in an account that isn't an IRA or a 401k or a workplace retirement plan. You can just open up an account on your own and invest in that account. Then you can pick whatever level of risk you want, whether that's on the very safe end of the spectrum, and that can include FDIC insured bank products, all the way to the other end of the spectrum, which might be much higher risk, including 100% stock or even other types of instruments. Now, we're going to assume that you've already done all of the saving and investing you want in your tax favored accounts. So maybe you maxed out your IRA, you've maxed out your 401k, and you've got extra money. So that could be a lump sum, or it might be that you have extra each month that you want to put away somewhere. Because these are not retirement accounts, they lack many of the features and restrictions that you might be used to with your IRA, your 401k, 403b, TSP, etc. That can be good and bad. On the one hand, it's a lot of flexibility that you have available, but on the other hand, you don't necessarily get all of the tax benefits that come with those accounts, like tax deferral or tax-free growth, for example, if you meet all the IRS requirements. For starters, there is no annual limit, so you can put in as much as you want. Again, after you've maxed out your 401k, you may have additional money. What do you do with it? Well, a taxable brokerage account is something to consider. There are also no income limits, so if you have the assets, you can put that money into an account and invest it. You also have complete flexibility on using the money, so you can withdraw it at any time. It doesn't matter what your age is or how long you've had the money in there. Now, there might be some product specific restrictions, so you have to dive into all those details, but no IRS rules say that you have to be 59 and a half, for example. Plus, you can use the money for any purpose. So it's not just for education expenses like a 529, or it's not just healthcare expenses like an HSA. You can really use it for any purpose. As a result, these can help you deal with surprises and emergencies. Now, I'm not sure these are the perfect option for an emergency fund. Typically you want to have your emergency savings in something that's very liquid and safe, maybe a high yield savings account or something like that. But some people do use their taxable brokerage account as their emergency fund. If they have lots of other assets, that's typically when that happens. Now, there is no tax deferral in these accounts. So unlike your retirement accounts, you will typically pay income tax and have it reported on any income you have in the account during the year. So we're going to talk a lot more about that later, but just be aware that they are called taxable accounts for a reason. Now, they can be surprisingly tax efficient. It's possible to take gains in these accounts at 0%. Not everybody can do that, but it is possible. And you might also get income at favorable rates. Just be ready to get a 1099 form at the end of each year, which is going to detail your earnings, like your interest, dividends, and realized capital gains. But you don't pay taxes on unrealized capital gains. So if you don't sell something, you don't take the gain, and it's typically not a reportable event. By the way, most of what I talk about is for people who are using pretty standard and boring investments, and they have modest levels of wealth. We're talking about those couple $100,000aires to the couple millionaires. So let's dive into some of those tax aspects. And again, this can get really confusing. So we're going to go over the basics, and this applies to the most simple situations. It covers a lot of people, but there are always exceptions and exceptions to those exceptions. Once you understand some of this, then you can start to come up with some strategies on managing your taxes. So the first thing to know is that your income is taxed annually. That can come from several different sources. You might have dividends, you might have interest and capital gains. We'll break down each of those a little bit more in a minute, but you want to be aware that these accounts can create some forced income. So you might get income even if you don't want it. It's going to go on your tax return. It might interfere with some things. So keep that in mind as you decide whether or not to use these types of accounts, and then as you choose the investments inside of the accounts. Now, if you receive a dividend, you don't have to spend it. You can just reinvest it. And what essentially happens is you're making a new purchase with whatever a dividend or an interest payment that you reinvest. You're adding to your basis essentially as you make new purchases. So you should not get taxed twice on that money, but you can reinvest it or you can spend the income you get. When you sell holdings in your accounts, you might have a capital gain or a capital loss if the market value changed. For example, let's say you buy a stock for $10 per share. There are no dividends, but over time, the market price rises to $14 per share. So you have a gain of $4 per share. Now, until you sell, you haven't realized a gain. But if you sell, then you lock in the gain or loss, which could affect your taxes. So again, if you don't sell, there is often no tax impact. Your realized gains and losses are generally taxable, and gains in a taxable brokerage account are typically reported to the IRS. So any assets that you held for 1 year or less have short-term capital gains, and any assets you held for more than 1 year have long-term capital gains. And again, there may be some exceptions here, such as when you inherit or somebody gifts you some property. In general, those long-term capital gains are taxed more favorably than short-term gains, and that's because those short-term gains can be treated as ordinary income and are potentially taxed at the highest rates. That's kind of like the earnings you get from a job. But long-term capital gains have special rates, and they might be taxed at 0% or 15% or 20%, depending on the level of your income. When you have losses in your account, you can potentially put those to good use, a little bit of a silver lining. You might offset some capital gains, which reduces what you owe in taxes, or you might even be able to reduce your ordinary income by up to $3,000 per year, which saves you a little bit on taxes. And keep in mind that you can also get capital gains without selling anything. So if you own a mutual fund that makes a capital gain distribution, you may end up getting some gains reported on your taxes even if you didn't do anything. What about dividends? So your investments might pay out dividends, and like capital gains, those dividend payments might be taxed at favorable rates. So depending on your income and depending on the type of the dividend, if it's a qualified dividend, then it can potentially get that low tax rate relative to the highest income tax rates. Next, we have interest. You're probably familiar with earning interest in your bank accounts from savings accounts and CDs. You can also get that in your taxable brokerage account. So if you own bonds, or you could even own CDs, for example, in that type of account, then you would receive interest payments. That is taxed typically as ordinary income. Again, very similar to the earnings you get from work. So it could be at quite high tax rates depending on your income. And that is going to be reported to you on a Form 1099 int. When it comes to all of these sources of income, a lot of times a brokerage house will send you a consolidated 1099, and that includes various sources of income like your capital gains and your dividends and your interest, so you don't necessarily receive three different forms. It's important as we think about all these income sources, we want to remember net investment income tax, and that's something that applies if your income is above certain levels, so not everybody's going to have it. But if your income is above certain levels, then you could pay additional taxes, 3.8%, on certain types of income. This doesn't apply to all of your income, like your Social Security or your IRA withdrawals, for example, but it could apply to investment income, such as dividends and interest. So watch your income levels and be aware that you may be paying extra tax if you have a high income. Now let's talk about the step up in basis. This is possibly one of the most powerful things that's available to you tax-wise in a taxable brokerage account. And what happens is this: if you die with holdings in your name in a taxable brokerage account, at your death, the cost basis essentially resets to the actual market cost of those investments on the day of your death. As a result, your heirs might be able to sell that investment with little or no tax impact. For an example here, we'll say Sue bought a total market index fund many years ago with $10,000, and ignoring any dividend reinvestment, the original shares she bought are now worth $50,000. So if she sells today, she'd have a gain of $40,000. And assuming a long-term capital gains tax of 15%, she'd owe an additional $6,000 in taxes. But if she dies while holding the investment, those gains are essentially wiped out and her heirs get a new cost basis. So assuming they can sell before the value changes, there might not be much, if any, gain on the position. So back to our example, continued here. She dies the next day, leaving the investments to Pat. And the market is roughly flat while they're figuring out Sue's estate. Pat then sells those shares for the $50,000 they're worth, and there is no capital gain or loss and no additional tax due for Pat. Keep in mind that things can get really complicated, especially if there are multiple owners and depending on what state you're in. So you want to verify all of the details with a tax expert and an attorney before you make any assumptions. That's because different ownership types can have a surprising impact on how the step-up works. Now that you understand some of the basics of these accounts, you can start to figure out some strategies that might make these tax efficient, even though, again, they are taxable brokerage accounts. One strategy is to control the taxable gains. So whenever you need money from a non-qualified account like this, you might be able to manage how the capital gains are treated or if they even materialize. So if you wanted to keep your income low, you could consider selling shares that have the highest cost basis or sell shares that have a loss, and that can minimize the impact on your taxes. In many cases, you can specify which shares you sell or just favor those holdings, those positions with the highest cost basis. Either way, you can basically limit that income. And this might make sense if you're trying to minimize your income to manage your health insurance premiums. Maybe you need extra money for spending or for emergencies, and managing your gains wisely can help you avoid problems. In an ideal world, you can also harvest your gains. So that means taking your gains at a 0% tax rate. And that could apply when your income is below certain levels and you want to check with the IRS for those current levels. But yes, you're hearing that correctly. You can potentially pay zero tax on capital gains. The challenge for most people is that any taxable income from other sources can bump up your income to levels that prevent you from harvesting those gains tax-free. So that might be IRA withdrawals, for example, or other sources of income. So we've got an example here where there's a single taxpayer. This person took $55,000 of capital gains for the year, a little bit of dividend for a total income around $57,000. She gets the standard deduction, which brings the taxable income to $42,000 in this case, and there is no tax due. So this person took about $57,000 of income and owed no tax. Now, let's say that this person faces a little emergency and needs more money. So what's going to happen is she's going to sell a little bit more. So now the total capital gains are up to $68,000, and that brings everything up into some higher levels, and eventually she'll owe about $1,300. But again, on $70,000, $71,000 of income, $1,300 in tax is not terribly ugly. And you can potentially pair that strategy with the next one of my favorite strategies. It doesn't work for everybody, but the Social Security bridge. Now remember that Social Security income is tax-favored income. That's because at least 15% of your retirement benefit would be tax-free to you, possibly even more if you can keep your income low enough. And again, we're talking about how you can keep your income low even with a taxable account. So maybe you're going to sell holdings, and that way you can generate some money you need to fund your spending. Meanwhile, you delay Social Security and allow that benefit to grow so you get as much tax-favored income as possible. The thing to remember here is that you don't have to take your retirement benefit right when you retire, nor do you have to take it as soon as possible. It might make sense to delay. And for some people, that's going to work really well. And for other people, it's not going to work. If you need the cash flow or there are other reasons, then go ahead and claim earlier. But this can be a very powerful strategy. A lot of times people do this this with their pre-tax accounts. So they delay claiming and they start spending down those pre-tax accounts because that helps to avoid big RMDs later in life. And again, those can mess up, how much of your Social Security is taxed. It can affect your Medicare premiums. It can complicate other things. But the same is true with these taxable brokerage accounts. You might want to spend down those assets. And the reason is, again, they can create forced income. So for example, if you had 300,000 in non-retirement accounts generating interest income at roughly 4%, you'd get about $12,000 of ordinary income if it's interest in each year. So by spending down some of those assets and maybe using that money to pay taxes on your Roth conversions, for example, whatever it may be, you can help reduce that account balance. And if you get it down to $50,000, then assuming the same yield, your forced income would be closer to $2,000 per year. Again, it used to be $12,000 per year. So what's the impact of that? Well, you could convert 10,000 more to Roth each year if you wanted, and then you would end up at the same level of income, or maybe less of your Social Security would be taxable each year, or you might keep your income lower for those health insurance premiums. So a couple of ways it could help you. Now, we haven't talked about harvesting losses. So that is when you intentionally sell something at a loss. And the reason you might do that is, again, it can offset some of your capital gains, or if your losses exceed your gains, you can potentially offset $3,000 up to $3,000 per year of income. But you might want to stay invested. So if you're going to use that strategy, look at how you can properly buy back in and maybe get a similar level of risk. You just can't buy substantially identical investments. That's what the IRS calls them. So just be careful about how you do that, but it's a nice way to potentially manage your taxes. Next, we have the topic of asset location. So if you are going to invest in these accounts, it could be worth looking at what types of holdings you have in each account. And again, all of this stuff applies more to people who have lots of assets and lots of tax problems. And it is not as important for those who have minimal assets. For example, if you're a 60-40 investor, like you want 60% of your money in stocks and 40% in bonds, one way to do that is to have the exact same allocation, 60-40 in your pre-tax IRA, 60-40 in your Roth, and 60-40 in your taxable accounts. Or a different way to do it is to spread out different types of investments. Maybe you favor stock in your Roth IRA because you want all of that growth to come out tax-free later. That's one way of looking at it. Maybe you want to avoid having something that pays a lot of ordinary income or interest in your taxable accounts. But this gets complicated and you really need to consider how you're going to use the accounts and really the overall makeup of your holdings. In general, the more tax efficient something is, the more sense it might make to hold that investment in your non-retirement accounts. So maybe a total stock market ETF is tax efficient. Maybe you want to hold that in your taxable account. But we just talked about how maybe it's good to have that in your Roth because you might want to get all of that growth out tax-free. But of course, we can flip-flop again and say, well, maybe it is a good idea to keep that in your taxable account if you expect it to get a step up in basis at your death. So there are a lot of things you need to consider. And as you explore the pros and cons, you're going to figure out what makes sense to go where. Along similar lines, it might make sense to evaluate which bonds you're going to hold in those accounts. Again, if you need to hold bonds in your taxable account and you have tax problems, then consider, for example, the issuers you're using. So there are municipal bonds, which would be exempt from federal and state income tax. That could work for you, although maybe you're minimizing the universe of investments you can choose from. Or there are treasury bonds, which wouldn't have state and local taxes, for example, but you'd still have the federal. If you live in a high tax area, maybe that makes sense. Again, you have to look at the pros and cons and what's it going to do to your diversification and risk factors as you pursue all of this. And keep in mind that again, things get complicated. So some of that interest might get added back into your income, even if you don't pay federal income tax on it. So those municipal bonds, for example, are going to be added back in. The interest is going to be added back in when you determine how much tax you have to pay on your Social Security benefits. Next, we have the idea of giving assets with gains. So if you have holdings that you bought, let's say long ago, they've gained a lot of value since then, you might not want to sell them because there's going to be big taxable gains, but you're doing some giving. Maybe you're giving to tax qualified charities or giving to loved ones. That's where those assets might be very handy. When it comes to charities, you can maximize your impact. So instead of selling the holdings and then paying the taxes on the gains and then writing a check for whatever's left over, you could just give the holding and give the full value of it right away. So these tax qualified charities do not pay taxes on the gains, unlike you as an individual, so they can put 100% of that value to work. And plus, you skip the step of selling, which puts that extra income on your tax return, which could cause some complications. This can also help you diversify a little bit. So if those holdings have grown to be too much of your portfolio, but you're reluctant to sell them, you can at least chip away at them a little bit as you give away the assets. Let's talk about RMDs for a minute. While this isn't really a tax management thing for a taxable account, it's important to know that if you get an RMD and you don't need the money, you can just reinvest it in a taxable account. And again, you can pick the level of risk that's right for you. The IRS just requires that you take a distribution, but they don't require that you spend the money or put it into a bank account. So if you don't need the money, consider reinvesting it. There are a lot of other tactics to consider. Just to highlight one or two more. One is turnover. So you want to be mindful of what you're holding. If you have an active mutual fund, for example, it's going to most likely generate more capital gains, possibly short term. But if you have passive index funds, those are a lot less likely to generate those types of gains. And you also want to be careful about rebalancing. So keep an eye on what's going to happen if you shift assets from one area to the other. What's the tax impact of that? And one other thing is to consider ETFs. If you have substantial assets, those tend to be a little bit more tax efficient than mutual funds. So you might lean towards those. And I've got a full video on that, which you can check out here. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thanks and take care.